Hi, and welcome to today's webinar on saving tax in retirement. My name's Rohan, I work for Hargreaves Lansdown, and my role is to help people understand their finances and make their own well-informed decisions to put yourselves in a better position. As I say, today's topic is how to save tax throughout your retirement, and there are three things that we'll be focusing on. Thinking about whether leaving your pension is a good idea for you, spreading out your withdrawals, and making the most of the government allowances available. I expect this will take in the region of 20 minutes, but we can speed that up or slow that down depending upon questions as we go through. One key thing to make clear is this is not advice. Your circumstances are unique to you, and therefore this presentation will cover tax rules and how to plan generally, but you will need to take some of these ideas and apply them to your own individual circumstances. This is of course based on our understanding of the current tax rules, but these are subject to change. If you are at all unsure, please do seek advice. We do have an advisory service available, and you can make use of that should you wish to. Just to begin with, I think it's important just to cover off the three main ways in which you can access your pension, and then we'll cover off small pots as well as more of a niche option. With all of these options though, you do have the ability to access up to 25% of your money tax-free. So I suppose it's what you deem reasonable or what you want to do with the remainder. That's the key determining factor. The traditional way in which to access a pension is by purchasing an annuity. Now, an annuity is when you get a secure and guaranteed income for at least your lifetime, so you can pass it on to others by handing your money over to an insurance company. So you get your 25% tax-free at the outset, and then you pass on the remainder to the insurance company, and they in turn give you a secure taxable income for at least the rest of your life. The next option is drawdown. Now, it starts off much the same as an annuity. You get your 25% tax free at the outset. The remaining amount is moved into a drawdown account. But here, you choose to invest that money however you see fit, and you take your taxable income from that as and when you would like to. The key risks here are that you are investing your own money. Investments can fall as well as rise, so you do need to ensure that you are comfortable with those investment risks and have sufficient money to tide yourself over in periods of poor performance of those investments. Lump sum withdrawals have many of the same features of drawdown, but it's essentially one way in which to take out larger lump sums or ad hoc payments from your pension. Of each lump sum, you get 25% tax-free and the rest is subject to tax, but it's all paid out to you in one go. Sounds rather similar to drawdown, but the key difference is that with drawdown, the taxable income can be spread out, so you could take your tax-free income now and then not take any taxable income for a year or two, whereas with lump sums, it's all paid out to you in one go. Now, small pots is best thought of as as another version of a lump sum withdrawal. Again, 25% tax-free, the rest is all paid out to you in one go. But this is specific to people who are looking to close down their pensions, and their pensions cannot be worth any more than £10,000. As I say, this is rather niche. If you had a smaller pension pot of £10,000 or less, this may be more appropriate. It doesn't limit the amount that you can put into your pensions in the future if you opt for a small pots payment. And the taxable element is all taxed at 20%, but if you actually owe a lower amount of tax, then you can reclaim that. Alternatively, if you owe a higher amount of tax, then you may need to pay that to HMRC separately. I would strongly urge people who are unsure or would like a further explanation on these options to go through the other webinars that we have available for you, and or make use of the website that we have, so hl.co.uk, and then the retirement section and the retirement guides that we have as well. There's a whole raft of tools and information to help you make your own well-informed decisions as to which retirement option or combination of retirement options might suit you best. It's vitally important that you understand those options so that you can make those decisions from an informed vantage point. So let's begin. So the first way in which to reduce your tax payments in retirement is, of course, to think about not taking your pension at all. Now, I think the best way to think about this is just to cover off the main benefits of the pension in the first place. Why was it such an efficient place for you to save throughout your career? Well, when you put money into a pension pot, you don't pay tax on those contributions. So you make an immediate tax saving on that pension. And in actuality, you may be able to continue to save money into your pension in the future as well, thus continuing to receive some tax benefits there. Then investments held within a pension pot are free from income and capital gains tax in the UK, which does mean that there's a further tax benefit as that money sort of snowballs and hopefully grows unchecked by tax. When you access the money from the pension pot, up to 25% is typically paid out tax-free. So that means that the longer and the larger the amount, the longer the money's in the pension, the longer it's got to grow. And the larger that pot may be, depending upon how those investments perform, of course, and that may result in you getting a larger amount of tax-free cash as a lump sum in retirement. And lastly, money held inside of a pension is typically free from inheritance tax. So leaving that money in that pension pot can mean that there is a tax saving for you there as well. So why leave it? Well, if you take the money out, you would lose that inheritance tax protection. When you flexibly access your pension pot, such as taking taxable income from your drawdown account, or taking a lump sum out, not including a small pots payment though, you will restrict the amount that you can put into your pensions in the future. It's limited by what's known as the Money Purchase Annual Allowance, or MPAA. If you do want to continue to save into a pension, you may not want to restrict the you may not want to trigger those restrictions, and therefore you may not want to access your pension in that way. This is especially relevant for people who are still working, potentially just cutting down on the number of days that you are working. You may still want to get the benefits of your employer's contributions into a pension scheme. Therefore, it's vitally important that you understand the impacts of accessing your pension. I've already covered off the fact that you might get a larger amount of tax-free cash. Effectively, if you leave it in there and it can grow with those investments, then that tax-free cash element can grow. And it's important to remember that even if you don't access it now, you can access it at any point. So you're not making your life harder by not accessing it immediately. One of the main other areas that you can save is an ISA. It's another account that the government has available to you so that you can save in a tax efficient way, and it stands for individual savings account. It's perhaps worth me contrasting the two savings accounts so that you can see the benefits of them against each other. They're both good, and they're both good for different reasons. For the ISAs, you don't get a tax saving on the majority of ISAs, the lifetime ISA excluded. A lifetime ISA is not available for people aged 40 or over. You don't get any tax saving when you put money in. So the money that you put in is the money that goes in. Compare that with a pension. When you put the money in, your pension provider may reclaim tax for you automatically. So basic rate tax, and you may be able to reclaim higher or an additional rate taxpayer depending upon the amount that you pay. Alternatively, with a pension, if your employer is making contributions for you, then they may effectively never pay tax on the contribution in the first instance. So if you are making contributions via your employer, check how tax relief or tax savings are being provided. But clearly there's no tax savings on stocks and shares ISAs or cash ISAs. In both accounts, investments are free from UK income and capital gains tax. When you take the ISA money out, it is free from all tax, but bear in mind that you did pay tax on the money before you paid it in, and the ISA is always part of your estate. Whereas with the pension, you didn't pay any tax on the money going in, or income tax on the money going in, and it is free from, or 25% of it is free from income tax when you withdraw it. There are, however, some restrictions. You can't access the pension until you're 55, so that is rising to 57 in 2028. But the pension is not typically part of your estate either, so there's some tax savings there. There's no clear winners here. You can access the money from an ISA whenever you want to, for example. But they both have their own pros and cons, and it's important to be aware of those because you may determine that an ISA is a place to take money from in the first place, or you may not. But as I say, it's important to be aware of those different options. And this is not the totality of the options available to you, but some of the most common and most popular ones. The next thing, if you do want to take your money out of the pension, let's think about how you withdraw it, and let's spread out those pension withdrawals. So how is pension income taxed? So as I've already said, 25% tax free at the outset. The remaining 75% is taxed as income, but it's not subject to national insurance. Your pension provider will deduct tax as instructed by HMRC, much in the same way that an employer does via a tax code. So what are the benefits of spreading out your pension withdrawals? So you may reduce your tax bill overall. Each tax year we get a personal allowance. It's currently £12,500. Then the basic rate tax band takes us up to £50,000. So if you can keep all of your earnings, for example, under £50,000, then you may get a lower amount of tax. You may pay a lower amount of tax over that length, over the length of your retirement, because it is taxed in the year in which it is received. So here, as I'm saying, it's better to keep yourself in the lowest tax band possible. So let's give you an example. Got a starting pension pot of £200,000. Going to move that into drawdown for the purpose of this example. Taking the maximum tax-free cash, £50,000, with £150,000 in the drawdown account. Now, I've just assumed for now that you've taken that full £150,000 out in one go. Just to be clear here, I know I've said it's drawdown, but actually if you were to do this, this would be exactly the same as if you took it all out as one lump sum. The tax would be pretty much the same. So you've got your £50,000 tax-free. You've then got your £150,000 of income. I've assumed that you're entitled to the full new UK state pension, which is £9,100 if you've got the full 35 years of national insurance contributions or credits and are of sufficient age. This level of income would put you into the additional rate tax band. So the very top element of your earnings would be taxed at 45%. The personal allowance of £12,500 I mentioned a few moments ago, that starts to get removed once your earnings are over £100,000. In this case, the earnings are such that the tax-free element, the personal allowance, has been fully removed as well. That's why there's such a significant income tax. So you've got the £102,505 there, plus the tax-free cash. That's a significant amount of money that's being paid as tax in this particular instance. I'll give you a different way of doing this though. Still got your pension pot of £200,000. £50,000 is paid out as tax-free cash as you move the remaining amount into drawdown, but you also take £20,000 in that tax year. Then in year 2, you can subsequently take out another £20,000. And I've just dropped that figure on the right-hand side down by by £20,000. I've assumed no investment growth, but of course the money in the drawdown pot can be invested. Those investments can fall as well as rise, but typically investments rise over time. So you may expect it not to fall by £20,000 each year, depending upon how those investments do. And it is important to consider those investments quite carefully. How does that work out? So you've got your £50,000 tax-free that's paid out in the first year. Every year after that, in that example, I've assumed £20,000 being withdrawn, plus the £9,100 of state pension, deduct income tax as appropriate. So in this case, you've got the full £12,500 of personal allowance. The income that you earn above that is subject to tax 20%, which means that a remarkably lower amount of tax is paid. £25,781.80 is paid out net, plus the £50,000 of tax-free cash, much more tax efficient. Hopefully that makes all of that clear and shows you the benefits of spreading out your withdrawals over a number of years. So let's come on to the final point, making the most of the government allowances available. I've already covered off the personal allowance, £12,500, but there are other allowances available. So the personal savings allowance, this is the amount of effective interest or savings income that you can receive. So that's such as interest that you might get on your bank. If you're a basic rate taxpayer earning less than £50,000, then that's £1,000. If you're a higher rate taxpayer, then it's £500. An additional rate taxpayer, unfortunately, does not get any personal savings allowance. Dividend allowance, this is the amount of effectively profits that you can receive from a company tax-free. That is £2,000 for the current tax year. And the starting rate for savings, if you're a relatively low earner, then in addition to the personal savings allowance, you may get an additional amount of up to £5,000 that you do not need to pay any savings, pay any tax on your savings. So that can be an additional benefit. There are also allowances in terms of what you may be able to save. The ISA allowance is nice and simple. It's £20,000 for people who are resident in the UK. Pension contribution limits, so you may still also be able to contribute to your pension. Pension contributions are limited by two things: the annual allowance, which is £40,000 for most people, but if you are a higher earner with gross taxable income of £200,000 or more, then your contribution limits, the annual allowance of £40,000 may be reduced. However, personal contributions are also limited by relevant UK earnings. This is typically defined as salary, and you can contribute the greater of the basic amount, £3,600 gross, or your relevant UK earnings. Pension contribution rules are relatively complex. Please do ask us questions if you want us to go through that in more detail, because it is certainly worth getting that right. So a few thoughts to consider. Utilise spouse's allowance. If you are married and you've both got an ISA allowance of £20,000 each, and you want to save more than £20,000, you can spread that out between the two of you. Equally, if you're both looking, if between the two of you, you want to withdraw £20,000, for example, think about how tax efficient it would be if, for example, your spouse withdrew it instead of you. If your spouse isn't working and you are, then there are some tax savings there to be had. That takes us on to the next point, the marriage allowance. You may be able to shift the portion, so 10% of the personal allowance between spouses, which can lead to a small saving. I think about £200, £250 off the top of my head, that you may be able to save if you do move your spouse's allowance. If again your spouse doesn't work and you do, and you're a basic rate taxpayer, you could move 10% of that of your spouse's allowance over to yourself and benefit from a greater tax saving. I've already mentioned this, but consider when and how to access your pension. Remember that your state pension is taxable, so that is a taxable benefit. It will count towards your personal allowance and your taxable income. Then also the lifetime allowance. The lifetime allowance is the maximum amount that you can save into your pensions, excluding your state pension, that you can save into your pensions and that those pensions can grow by without incurring an additional tax charge. It's currently set at 1.0731 million. The reason it's not a nice round number is because it increases in line with inflation each year, but effectively it limits the amount of money that you can take out of your pensions. When you access your pensions, whether that's by buying an annuity, drawdown, taking lump sums, is tested against the lifetime allowance at that point. If you have a final salary scheme, then that will also be subject to the lifetime allowance. If you do need help in understanding the options available to you, then PensionWise is a free impartial service from the government. Their website is very good. It has a whole range of resources available to you. Simply pensionwise.gov.uk. They do also offer face-to-face meetings and telephone consultations, and do make use of those. The more information you can get, the better. So please do note down their details and contact them and make use of the information that they have. So a bit of food for thought. 3 key things I want you to consider, I suppose, in addition to the 3 sort of tax saving tips. Think about whether you need the income now and how much you need. Where do you want to be drawing that money from? What's more tax efficient now and in the future? And what allowances and exemptions do you have, and can you make use of those? Contact us if we can help you. The phone number there, so 0117 980 9940, goes directly through to our retirement team. They're on hand and they are specialists in this particular area, or email them if you've got questions. Now, just take a moment to read through this slide. Just to be clear, that retirement team, they cannot provide you with advice, much the same as this presentation. It's not advice. However, we can put you in touch with an advisor who can talk you through the options available to you and can go into much of the areas discussed here in further detail. But do make use of all the resources available. Use our website, hl.co.uk, use PensionWise, and do certainly take some time to think about how best your retirement can be, your ideal retirement can be achieved. But thank you for listening in, and hopefully you found that helpful.